Welcome to the Pro Ticker Deep Dive. Today we're diving into something that sounds pretty technical on the surface, but really represents a quiet yet massive revolution inside bank balance sheets over the past decade or so. We're going to peel back the layers on the creation of what you might call a new middle class of debt. We're talking about preferred senior bonds.
That's a great way to put it. This is basically a story of, well, liability engineering, banks getting strategic, redesigning their debt structure, mainly to handle much stricter regulations, but also trying to keep investors happy along the way. So our mission today is to really unpack this hybrid category, born, frankly, out of necessity, and figure out where the real risks and maybe some opportunities lie for you, the informed listener.
Right, because there's this fundamental conflict at the heart of it all, isn't there? Banks have to make their balance sheets safer. They have to protect those traditional senior bondholders, but they can't just make everyone perfectly secure without costs soaring.
Exactly. And this preferred senior debt is the answer they engineered. It slots right into that middle ground. It's designed to be, well, the first line of defense after the riskier stuff, but before the most protected debt gets hit.
Okay, let's get into segment one, the age of liability engineering. To really get why this debt even exists, we need to rewind a bit, back to the post-2008 world.
Yeah, the macro picture is key. Banks, especially in Europe, were under immense pressure from two sides throughout the 2010s. You had politicians and regulators demanding safety, basically saying no more too big to fail.
Absolutely, the scrutiny was intense.
And then on the other side, you had markets absolutely starved for yield. Remember, central banks had rates parked near zero for years. So intense pressure for safety, intense pressure for returns.
A real squeeze.
And it's crucial to underline this. Preferred senior debt wasn't some brilliant financial innovation dreamt up for its own sake. It was essentially a regulatory creation, pure necessity. It gave banks a tool they desperately needed to meet these huge new loss-absorbing requirements. You hear the acronyms MREL and TLAC thrown around.
MREL and TLAC.
Right. They sound complex, but what do they actually force banks to do?
Think of them like this. Mandates saying banks have to pre-fund their own potential failure. They need a thick layer of debt, ready and waiting, specifically earmarked to take losses if the bank gets into trouble.
So the idea is the bank can be wound down, resolved, without taxpayers footing the bill again.
Precisely. The rules basically force investors, not governments, to recapitalize a struggling bank. And to meet those rules, banks needed billions in new debt that could absorb losses, but critically, debt that was cheaper to issue than, say, core equity or even traditional subordinated debt.
Okay. And that's where preferred senior slotted in perfectly. The sweet spot.
Exactly the sweet spot, especially back then in the low-yield world. If you were an institutional investor hunting for any extra return, this new paper offered a noticeable pickup, maybe 30, sometimes up to 60 basis points over the absolute safest senior debt.
Which doesn't sound like much now, but back then it was significant. So it was a decent trade-off for investors, and it let banks build those required buffers without paying the much higher price for issuing riskier stuff like Tier 2 capital. It helped them optimize things.
That makes sense. But that balance, that equation didn't last forever, did it?
No, it definitely shifted. Around the mid-2020s, when inflation took off and interest rates finally jumped up from zero, suddenly that extra 30 or 60 basis points started looking, well, a bit thin.
Right. Investors started asking tougher questions.
They certainly did. Is that small premium really worth the risk, the bail-in risk specifically, especially when you can get decent returns on much safer assets now? That shift has really forced everyone to rethink the value proposition of this debt.
Okay, let's move into segment two and define this hierarchy more clearly, this middle-class debt. If you picture a bank's liabilities like, I don't know, a tower, where does preferred senior actually sit?
It's smack bang in the middle. That's why the middle class analogy works quite well. It's preferred because it ranks above the really high-risk stuff, think subordinated debt, like Tier 2 capital or those COCOs, the AT1s.
Okay, above the riskiest layers.
But crucially, it's still junior to the safest, most traditional debt, what's often called classic senior unsecured debt, or sometimes you'll hear it called non-preferred senior, depending on the jurisdiction. It can get a bit confusing with the names.
So just to be crystal clear for the listener, if a bank actually fails, the classic senior debt holders are kind of first in line for safety, relatively speaking.
Yeah.
But the preferred senior holders, along with everyone below them, could face losses.
That's the design. The key phrase is bail-in status. And let's be really explicit. Bail-in-able means if a bank is failing, the regulators have the power, the legal authority, to either force those bonds to convert into equity or just write down the principal amount.
Ouch. So the investor essentially pays for part of the rescue.
Correct. But the critical distinction in the order of things is that preferred senior absorbs losses after the subordinated debt gets wiped out, but before that classic safest senior debt is touched. That's the theory anyway.
That specific position is what makes it such a unique compromise, I suppose. And the market certainly reacted. You mentioned banks needing billions. The supply side must have been enormous.
Huge. Especially from the mid-2010s onwards, European banks were in a race to fill up those MREL quotas. We saw massive issuance volumes, particularly from banks in France, Germany, and Spain were very big issuers early on.
In all that issuance, it created a kind of market signal, right?
Absolutely. Preferred senior spreads became this really interesting real-time barometer for how the market perceived regulatory risk. When regulators hinted at tightening the screws, demanding more loss-absorbing capacity.
You'd see issuance jump and spreads widen.
Exactly. Investors demand a bit more compensation for the perceived risk. And conversely, when the market felt more stable, more confident about the banks, those spreads would tighten up again, reflecting a greater sense of safety. It became a very sensitive indicator.
Fascinating. Okay, segment 3. Let's talk opportunities, risks, and maybe this illusion of safety. What are the clear wins here? For the banks first.
For the banks, it's fundamentally about efficiency. It's a cheaper way to meet those really demanding regulatory capital goals compared to funding entirely through expensive subordinated debt or equity.
So hitting the targets without killing their funding costs.
Precisely. And it's also a signaling tool, right? Issuing this stuff shows regulators and the market that management is taking capital safety seriously, being proactive.
Makes sense. And for investors, what's the draw?
Well, it comes back to that yield enhancement we discussed. Plus, these bonds typically still manage to get investment-grade ratings, which is important for many institutional buyers.
So decent yield, still rated investment grade.
Right. If you choose carefully stick with the big, systemically important banks, they can offer pretty compelling risk-adjusted returns. Think large pension funds, insurance companies who need that steady, relatively safe income stream.
Okay, but now the risks. And this seems to be the crux of it, the complexity.
Right.
Our sources suggest the biggest danger isn't necessarily the bank defaulting outright, but understanding how this all works in a real crisis.
That's spot on. The complexity is a huge risk. Very few investors, even sophisticated ones, truly grasp the practicalities of the bail-in hierarchy when push comes to shove. How does that line between preferred senior and classic senior really hold up under extreme stress?
Especially because the rules aren't perfectly identical everywhere.
Yeah.
Right? Different countries in Europe might have slightly different legal setups for bank resolution.
Exactly. Those inconsistencies add another layer of uncertainty. The lines can definitely blur when the financial sirens are wailing.
And that complexity, you argue, leads to maybe an illusion of safety.
I think that's the critical risk, yes. Remember, these instruments are explicitly designed to absorb losses. That's their entire purpose in the regulatory framework. So, in a crisis, let's say a major bank failure leading to resolution, there's a real possibility that regulators might treat these preferred senior bonds almost like quasi-equity to get the job done quickly.
Wait a second. Quasi-equity. Does that mean, isn't that essentially saying the preferred senior bondholder who thought they ranked above subordinated debt could actually end up taking losses before the shareholders are totally wiped out? That sounds counterintuitive.
It sounds counterintuitive, but it's a very real risk embedded in the resolution process. While legally they rank higher than equity, the practical need to stabilize a failing bank quickly might mean preferred senior investors are forced to absorb losses much earlier in the process than the textbook hierarchy suggests.
So they become the shock absorbers to save the system and protect the classic senior debt holders.
That's the potential sacrifice you make by sitting in that middle tier. You provide the capacity needed for the resolution authority to act decisively. It's a tough spot.
And there's another risk too, right? Liquidity.
Yes, definitely. Don't forget operational risks like liquidity. These preferred senior issues are often smaller, less frequently traded than the huge benchmark classic senior bonds.
Meaning, if markets get choppy.
If markets seize up, or if there's bad news hitting the banking sector, finding buyers for these bonds can become very difficult very quickly. Spreads can blow out dramatically, trading volume can dry up, and you might struggle to sell without taking a significant loss. It's not as liquid as the top-tier debt.
Okay, let's shift to segment 4, the technical view. How should we think about valuing these spreads?
Well, technically, it's now a distinct asset class with its own dynamics. As we mentioned, preferred senior spreads typically trade somewhere in that 30 to 80 basis point range above classic senior bonds from the same issuer, same maturity.
Though that range can vary a lot.
Oh, absolutely. It depends heavily on the specific bank's credit quality, the country it's in, the time to maturity. Banks are actually quite clever in managing issuance across their debt stack to make sure these different layers price appropriately relative to each other. They don't want cheaper funding options messing up the pricing for the riskier debt they still need to issue.
And what about how this sector trades? You mentioned its sensitivity earlier.
Yeah, the market behavior is quite predictable in some ways. It shows pretty clear mean reversion. When general market volatility picks up, like during sharp rate hikes or if there are negative headlines about banks, these spreads tend to widen out significantly.
But then they snap back.
But then they usually retrace, sometimes quite quickly, as conditions normalize. So active traders often look for opportunities during those periods of temporary dislocation.
Now, you mentioned something earlier that sounded quite important, perhaps a bit worrying, the convergence story.
Yes, this is genuinely fascinating and maybe a little alarming. If you look at a chart of the spread difference between preferred senior and classic senior over the last few years, you see a pretty clear trend.
Yeah.
They've been moving closer together. The premium for holding preferred senior has been shrinking.
So what does that convergence tell us?
Well, it suggests one of two things is happening. Either investors collectively are starting to underprice the real bail-in risk we've just been talking about, maybe getting a bit complacent,
Oh.
or they have enormous faith in the regulatory safety net. They might believe that the system is now so robust or that regulators would intervene so early that these bonds will likely never actually be called upon to absorb losses, despite being designed for that exact purpose.
That's a huge bet on the system working perfectly, isn't it? Essentially saying, yes, it's bail and sable on paper, but it won't happen to me.
Precisely. That underlying trust, or perhaps complacency, is what's driving that spread compression. But for people actively managing money in this space, there are some technical levels to watch. Our sources suggest keeping a close eye on the spread differential relative to subordinated debt from the same issuer.
Okay, what are the key thresholds?
When preferred senior spreads get really wide, say exceeding 150 basis points over the risk-free rate, that often triggers rotation trades. At that point, some investors might look at high-quality subordinated debt and think it offers better value for the risk.
So a relative value switch kicks in.
Exactly. And on the flip side, if that spread premium for preferred senior drops too low, say below 50 basis points compared to classic senior, its value proposition becomes really questionable. You're not getting paid much for taking on that distinct bail-in risk.
Got it. And one last point on the technicals, the issuance outlook.
Yeah, it seems a lot of the necessary issuance has been front-loaded recently. Banks have been rushing to meet those stricter MREL deadlines that are coming up.
So they've issued a lot already.
Quite possibly. The implication is technical. While we might still see primary issuance, the amount of bonds available for trading in the secondary market could actually thin out a bit once full compliance is achieved. That reduced supply could potentially be a positive factor for prices down the line. A technical tailwind, perhaps.
Interesting. Okay, let's wrap this up in our outro. So, recapping today's deep dive. Preferred senior debt is this really unique animal in the financial zoo. It's partly a creation of regulatory necessity post-crisis, partly a market response to the low-yield world, and definitely a complex compromise in how banks structure their liabilities.
It really underscores that point. How a bank funds itself, the structure of its liabilities, is just as critical today as what it actually lends money to. The plumbing matters immensely.
Absolutely.
And maybe the final thought to leave with you, the listener, is this. What happens next with this debt category probably depends less on the fine print of the next regulatory update and much more on market confidence, on sentiment.
Okay.
Well, if these spreads stay tight, even with interest rates now much higher than they were, it suggests the market has deep, maybe even complacent trust in the banking system's overall resilience, particularly in Europe. But if risk appetite really starts to fade for some reason,
Then this middle layer gets squeezed.
then this vulnerable middle layer could very quickly become the critical testing ground, the bridge between that perceived safety we talked about and the actual necessary sacrifice required in a crisis. It forces you to constantly question where the real risks lie in that hierarchy.
A crucial balancing act. Definitely something to keep watching closely. See you all in the next Pro Ticker Deep Dive.